Hey everybody, it's Paul here on my channel, Better Call Paul, and we're at that time of the month where fund managers are announcing distributions, and sometimes we see those distributions going up, sometimes we see them going down, sometimes they stay the same. Well, in today's video, we have the fortunate opportunity of having a special guest who can explain some of the behind the scene details as to how fund managers come up with these distributions. So everybody, let's welcome to the channel. Hey, Elliot, welcome to the channel.
Hi, how are you? Good to see you, Paul.
I'm great, Elliot. Thanks for taking time. I know you guys are always so busy, and you've taken some time to speak with me today. So maybe could you just introduce yourself to the viewers first?
Yeah, sure. So my name is Elliot Johnson. I'm the Chief Investment Officer and Chief Operating Officer and one of the principals here at Evolve. And just as a recap for those of you who might not know a lot about Evolve, we started Evolve back in 2017, so just under 9 years ago. We launched our first ETF. We just celebrated a $10 billion milestone last week, crossing 10 billion in assets under management.
Wow.
And probably quite relevant for your audience, almost 4.5 billion of that is in covered call ETFs. And so we're really pleased with the reception that we got from the market, bringing these products to the Canadian market, and really happy to have a chance to talk with you today.
Yeah, you know what, Elliot, I'm trying to remember when was the first time I saw Adriano interview your founder and CEO, Raj Lalla. It's been a few years for sure, but I was impressed from the first time I saw him speak and explain how Evolve was founded. And since then, I've been a holder of bank and Utes and other funds that you guys have. But today we're here to focus on Biggy, and so Biggy has announced a distribution cut. Before we address the cut, could you explain how Biggy is structured and the rationale behind the UltraYield lineup?
Yeah, for sure. So Biggie is our first fund that we launched with the UltraYield formula in the back half of last year. We now have 6 ETFs in our UltraYield lineup. We just launched another one this week. And the way in which we built UltraYield, we designed these products to deliver a high level of distribution for income-oriented investors. That was really our focus. It's why we pay the distributions twice per month. We are focused on having a relatively small basket of large cap, well-known companies that everybody is familiar with. They're the companies that typically are showing market leadership. Now, we generate the extra yield through covered call writing, which I'm sure your audience is very familiar with, but I'm happy to get into the details of how we do that. We roughly cover about half of the portfolio with calls, and we write them as far out of the money as we can to still hit our yield target for each individual fund. Now, to add to the formula in order to generate the yields that we're targeting, the distributions that we're targeting, we add 33% leverage, or up to 33% leverage, which enhances income, but also comes with increased risk. And I just want to point out up front, these funds have less than 1 year of track record, so I can't speak directly to any performance metrics specifically.
Right.
But I can tell you it's a very popular lineup, and since we launched it last year, we have over 750 million now across the 6 ETFs in our UltraYield family.
Wow, they're doing fantastic. So these really are designed more for income than they are for growth, and hence the name UltraYield. Now, Evolve has not previously cut a distribution. So could you take us through the decision and what prompted it now? And what is the revised distribution for Biggie?
Yeah, so we took this very seriously. We did not take this decision lightly. As you said previously, we've not cut a distribution, and we know that investors rely on these distributions for their cash flow needs. And I want to be very clear, we can't provide advance notice on this for regulatory reasons, so I apologize up front for any investors who feel surprised by this news, but the press release itself is the announcement, and unlike a stock that cuts its distribution, the supply and demand for the fund doesn't affect the price of the fund. The fund's price is based on what it holds inside the fund. So really the announcement of our distribution is a notice for investors that there's been a change, and it's also why I'm here today to talk about it. We made this change for the long-term stability of the fund. We initially launched at 31.25 cents per unit, which we believed was attainable at the time based on the market conditions and the portfolio that we held. And that's paid twice per month. Today, we're changing it to 20 cents per share. realigning the payment relative to the current unit price to what it was when we started the fund. And again, that payment is twice per month. I'd just like to mention a few elements to the fund and why a lower distribution is something that we've chosen to go with at the moment. Higher distribution targets requires writing more options on the portfolio and writing them much closer to at the money, which means that the strike price of the option is the same as the price of the stock when you write it. That's what at the money is. So out of the money means the strike price is higher than the price of the stock. So by lowering the distribution, it allows us to write fewer options and have them be higher out of the money than we otherwise could by maintaining a higher distribution. And that allows the portfolio to participate more in upside of market performance. And this is something we think is an important consideration for the long-term health of the fund for the long-term shareholders who are in the fund. But it's really balancing that trade-off between distribution size as well as market participation that we think about every day in our covered call program, right? Our call program is active, as you probably know. We got a team of option specialists who are writing the calls every day and trying to balance out the earned income from the distribution, from the premiums we're getting from the options, and the distribution that we're targeting is a key element of that. And so we do have to react to market conditions. And we have in the past changed our distributions on other funds by increasing them when market conditions have warranted as well. And so, I really do want to make sure that we have a good conversation about how we're thinking about this and how we're running these funds so that we can be very clear with what we're doing for our investors.
That's amazing. Elliot, so for the viewers and for people who are not into options trading like myself, what I think you're trying to say is by targeting a lower distribution, you guys have the opportunity for more upside, which will increase the NAV over time, could increase the share price. And I think a lot of people would like to see that, Biggie to get back up maybe over $20 a share or something. And then at that point, you guys could reconsider the distribution once again and maybe reset it a little bit higher than it is today. I think it's a great idea.
Yeah, thanks. I think it's a good way to put it. I mean, we obviously need to balance out the long-term viability of the fund with the distribution that we're paying. And so I think you put it well in terms of the rationale for why we're doing it today.
Yeah, so I guess you could say that this is not necessarily a one-time reset. There could be further adjustments. Maybe explain that.
Yeah, so we cannot talk for regulatory reasons about the plans for where we're going with our distributions. We also don't know what they're going to be because market conditions in the future are not known. So obviously our net asset value, that's the unit price for each share of the fund, is down from when we launched the fund, and that is a result of the portfolio performance. So initially, when we brought this product to market, we picked as the holdings the Magnificent Seven companies, as they're called, Microsoft, Tesla, Apple, Amazon, as well as two crypto names, Coinbase and MicroStrategy. And we did this for a few reasons. The Mag 7 names had been market leaders over many, many years. And what we've seen over the past year since we launched Biggie is there's been an unusual market condition where leadership in the market has really expanded to include semiconductor names from this AI boom that's happening now. And it's also added more volatility in terms of the movement of given names on any given day. But it's a different market condition than we saw in previous years. So we actually, about a month ago, expanded out our portfolio to include some of those AI names, along with some lower volatility names that we added to the portfolio as well to try to balance these things out and to try to diversify what we had. Because you have to react to the market when the market's telling you which way it's going, and that change in leadership was significant. Also, over the past year, there's been a bear market in crypto assets, which caused those two names to have lots of volatility, which was useful for our option selling program, but also to have negative price return on those positions as well. They're still in our portfolio. The initial portfolio is still in the portfolio. We're very constructive on those names. We remain very much of strong conviction that these are the companies that will continue to display leadership over time. Large cap US equities in tech have traditionally been a good performer in portfolios. But just to highlight the market conditions we've been in and how unusual they are, we have a couple of funds on our lineup that kind of tell this story. One is our FANGMA ETF, Facebook, Apple, Microsoft, Netflix, Google, Amazon. The ticker is TECH. And another one is QQQT, which is the 46 companies in the NASDAQ 100 that are technology. So the first one is the concentrated kind of a Mag 7 style basket. The second is a much more diversified group of technology companies. And if you look from the end of July of 2025 to the end of July of this year, tech had a price performance of 5.94%, and QQQT was up 36.12%.
Wow.
And it shows a real rotation of leadership in the market as it relates to US tech companies. And that is that's a different market condition than in previous years. So what we're doing today is partly in reaction to that, partly in reaction to the fact that the overall performance of the portfolio needed to be adjusted because of market conditions. The volatility of these names was productive for our option selling to generate the premium we're earning to pay the distribution, but we have to balance things out. And we have to recognize the market that we're in is not always the same at all times. And so I just wanted to provide a little bit of that background so that investors could kind of get some context for what we're looking at as a portfolio management team when we're thinking about the portfolio for Biggie.
Yeah, I've definitely seen a big shift in my portfolio starting, I guess, back in November of last year because of crypto. You know, I had funds that were in, like you said, MicroStrategy or Strategy and Coinbase. And, you know, I took big hits on those ones, but I'm a long-term holder. And as long as they continue paying out, right, we can wait it out and hopefully the recovery will be coming sooner than later. But when it comes, right? What are some of the names that you guys added to the portfolio for Biggie?
Yeah, we added Walmart. We added Berkshire Hathaway.
Nice.
You know, just to pick a financial name that, you know, I mean, Warren Buffett, right? He's been a great investor for a very long period of time. So, you know, those kinds of names, which are names that we've had within our other portfolios over time. These are definitely still, I just want to be really clear, these are still very much in the category of blue chip US equities. We are not, that's really where this product lives. Mm-hmm. We're not looking to have, 500 names like the S&P 500. We have a product for that. S&P 500 would cover calls, but this is supposed to be concentrated, relatively speaking, group of large cap US equities that we feel are going to be successful over the long run.
Okay, so you guys have also a fund of fun, Easy, which I love. I love the ticker name. I immediately sold Canny and put it all into Easy, but I'm still holding Biggie and Easy. But for people who might also hold Easy, how does the distribution cut with Biggie flow through to Easy? Does it affect that distribution as well?
Yeah, it does. So Easy is a fund of funds wrapper, and Easy holds approximately 45% Biggie, 30% Canny, and 25% Inti, which is our international ETF for UltraYield. All three of those are UltraYield. It just passes the distribution straight through. So because of the Biggie distribution cut, Easy's distribution is going to move from 31 cents to 25.5 cents paid twice per month. But that's because only Biggie is affected. Canny and Inti distributions are unchanged. But it does have that knock-on effect on Easy.
All right, Elliot, you guys have recently come out with a fund called Techie, the NASDAQ Technology UltraYield ETF. So could you describe that fund for the viewers?
Yeah, this really came from feedback from our investors and folks like yourself who saw that we had two products already that track this technology-only companies in the NASDAQ 100. I mentioned QQQT. That was the original one that we built with NASDAQ. We sat down with them. We were having lunch with them one day and said, hey, how many companies in the NASDAQ 100 are tech stocks? And at the time, it was 31. And we thought, that's odd. People use the Qs as a tech allocation, but they've got, other companies like Costco and Pepsi and Marriott that are not tech. And we said, can we just get a tech version of that? They made that index for us. And after launching QQQT, we decided to add our cover call program to the top of it, our active cover call strategy. And so we launched QQQY.
Right.
That product, QQQY, is coming up on its third anniversary this October, so in a couple of months. And we kept getting feedback after we launched our UltraYield lineup that people would really love to see an UltraYield version of QQQY. So Techie, the ticker is TECY, holds QQQY and then adds 33% leverage just to get it to be run the similar way to the ultra yield strategy. So it's for investors who are looking for pure play tech investing, who are comfortable with the risks and amplified risks and return of leverage, and are okay with the volatility of technology names, but are looking for that broader basket of technology stocks than they might find in similar products.
I bet you guys are getting an email from Adriano on a weekly basis. Can you please add leverage to QQQY? Can you please add leverage to QQQY?
Yes, he did mention it more than once. So, we...
I think I've seen that in a few videos.
It's true.
All right, you guys launched another ETF called CAMO, which I kind of like the name of that one as well. You guys are great at picking these names. So can you explain that one and how it fits in with the broader Evolve lineup?
Yeah, for sure. So this is not a covered call fund. This is just a straight long equity fund. It's the Evolve Global Defense and Aerospace Index ETF. It's the 30 largest defense and aerospace companies globally. And when we put this together, we've deliberately weighted it to be mostly non-US companies, because investors already have a lot of US defense stocks in their S&P 500 allocation. And what they're missing in their portfolios are non-US names. And the reason why that's so important today, very sadly, is because the world is becoming a more dangerous place. And obviously, we all know the sad news from Ukraine and Iran and other places around the world where there's war going on. And what's happened as a result of those conflicts is that there's a very big rearmament happening right now. Europe is in the middle of the largest rearmament since the Cold War.
Wow.
And NATO members are now committing to 5% of their GDP to be spent on defense by 2035. So there's a lot of countries investing in defense spending. But the other lesson that's come out of these recent conflicts that is causing this to accelerate is that we've really seen since the advent of drone warfare that a lot of countries that have legacy armaments built up, tanks and other things, need to replace them with higher tech weapons, because the drones are really the new way in which war is being conducted. So this is again spurring a renewal of the investment in weapons technology around the world. And so this rearmament is going to happen over many years and many budget cycles. And so we think that there's an opportunity now for investors who see this trend to invest in it on a global basis, because it's not just a US story at all. And so that's really why we put the fund together, and we've had some great response so far. It's only been around for a couple of days.
Great. And this, Elliot, this is a pure growth. Like you said, there's no covered calls on it. Is there,
That's right.
I guess there's an opportunity somewhere down the road you guys might add covered calls to this fund and put it in one of your other suites?
You never know. That QD was that way, and then QQQY. So we'll see what the interest is. Let's see what the feedback is. Maybe some of your audience could say in the comments if they're interested.
Yeah, I'm definitely interested. I've been trying to diversify my portfolio. I added healthcare recently. I got a lot of utilities, and I think defense, like you said, this is growing. It's not going away. So there's probably likely a demand for it in the income space as well. I think we've covered just about everything in regards to Biggie and cutting the distribution. Is there anything else you think maybe viewers need to know, or questions they might have as well?
I would just encourage people to visit our website at evolveetfs.com. We posted a blog about the Biggie distribution cut, going through the rationale, the explanation, and our thoughts on the matter as well. So I would encourage people to read that if they have further questions or want to follow what we're doing. As I said to you before we started recording, we're very committed to transparency. That's why I'm doing this video. That's why we posted that blog. That's why we show all of our holdings, including our options, every day. We think it's really important for investors to know what they hold when they invest in an ETF. So I really appreciate you taking the time to have me on your channel to talk about this, and appreciate being able to speak to your audience about it as well.
Yeah, Elliot, I mean, as an income investor, and I think for anybody who's an income investor, we have to realize that there are times where you guys can increase distributions, and you have done so with some of your other funds. Financials have done really well, so those got to bump up. And sometimes some ETFs, the distributions have to be cut, but it's all in how you guys manage these ETFs for the future, right? It's not just about what we can get today. We need these funds for the next 20, 30 years so that we can retire and go on vacation and stuff.
That's right.
Yeah.
We're all in this together.
Yeah. So I think people just have to understand, you can't just be happy when they're going up and then get mad when they're going down. It's a balance, right? And it's like you said, it's based on the markets. You guys don't control the markets, but you can only do with what the market gives you. So I appreciate everything you guys do, and I appreciate you taking the time to come on my channel.
Thanks very much, Paul.
Thanks. Everybody have a great week, and we'll talk to you later. Bye for now.